the windows for bears to act in are very, very short. And the liquidity keeps flowing in terms of deficits, in terms of PTFP. Nothing of the sort has changed. So show me that's something that breaks like chunk, and we can talk bear. But it hasn't broken.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro analyst Sven Henrich. If you haven't yet watched part 1 of this discussion with Sven, in which he explains why technical analysis suggests the markets may have a lot further still to run higher this year, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Okay, let's get started watching part 2 of our interview with Sven Henrich.
Purely technically speaking, I have a hard time making a bear case at this particular juncture. I can make a corrective case that leads for a pullback in September, October, maybe with a volatility spike. You know, if the VIX goes above that monthly trend line that I mentioned, stays above it, yeah, then things could change very quickly. You know, but it hasn't happened, and the technical position of this was very impressive. And then I want to throw in one final point here. And this has nothing to do with technicals, has nothing to do with macro. It's kind of a human factor. Because we do have a presidential election next year. You know the names that have been with us for years. Yellen and Powell, Jay and Janet. Janet Yellen is 77 now. Jay Powell is 70 now. They've both hung their necks out on this soft landing. Trump, whether he's going to run again or be nominated again or elect again, I don't know. I have no clue. But he's been publicly saying he's not going to renominate Powell.
Right.
May mean nothing, but it's kind of a signal out there. I can't look in the head of Jay Powell. I don't know how much longer he wants to do this. Janet tried to get out a couple of times, but I think she was pulled back in. And I think she's committed until the election in November. If Biden gets reelected, I don't think she stays. I think she's retiring. And the reason I mention that is both have a vested interest in going out on top, preserving their legacy, if you will. Now, this is completely speculative on my part, but I can just see it, that they don't want a recession. They want to avoid it like the plague. And they will do whatever they need to do to avoid that from happening. I mean, if that's the business you've been in for decades, you know, that's the legacy you want. You know, you created a soft landing by, now back to collecting speaking engagement fees. Mm-hmm. I'm just saying, we saw this in October when Janet Yellen was concerned with liquidity in the treasury market. We saw it in March when she was concerned about the banks. And every single time, these were major market pivots. So I suspect that, you know, they will do their dearest to avoid any major market hiccups. In fact, the one factor that all of us should be aware of as well, which makes this entire cycle so unusual. The US government is spending money like we've never seen before during a non-recessionary environment.
Or non-wartime environment, yeah.
8.5% of GDP deficits. There were only a couple of periods where we've seen anything like it. One was the global financial crisis. I think it was like 9.5%. Now, the other one was, of course, COVID, when they threw the kitchen sink at things. Mm-hmm. During the recession in 2003, it was around 4.5% deficit spending.
Right. And sorry to interrupt, but I've shown a chart recently that shows not only is the percentage abnormally high, but it's never been this high with unemployment this low.
Yeah, it's absolutely stunning.
It's crisis level spending when we have a robust economy.
And typically when you have this type of spending, when you are in a recession, guess what markets do?
Right. They go up.
They rally.
Yeah.
They rally.
And to your point about human element, some people think that this is engineering for stability through the November election of next year.
Yeah, I mean, look, whether, it doesn't matter which party you're in favor of. Any party that's in charge does not want to have a recession during an election year. Ironically, that has happened a couple of times, right? It happened in 2000 and it happened in 2008. And guess what? Everybody was out. If you're in a recession during an election year, you're out. Goodbye. Right. So they all have an incentive. Whether they succeed or not, that's a completely different question. They certainly didn't succeed in 2000. They didn't succeed in 2008. And by the way, speaking of seasonality chart again, the first quarter in a presidential election year is typically quite shaky. So you may see that big year-end run and then some sort of correction again at the beginning of the year. And then they typically run, unless you are in a recession, right? And so that's what it then comes down to, this whole runway discussion, given all the factors we mentioned at the outset. If you do have a year and a half, this can drag on into 25, and then the recession hits, right? So in many of these cases, you just simply have new all-time highs first before something burns down. That was the message from the 1-year yield, right? That was the message that we saw with these August NIMO readings. That's what we saw with these big crashes that never even produced down years, 1987 and so forth. So there's a lot of history to consider. And then I guess my final point on this is just to say, again, observing all these mega rallies and these tiny windows that bears have to play, it's kind of an eye-opener. And it's been like this for many years, So
All right.
I guess my base premise on all this is, and I hate to say it, I'm probably going to get creamed for this on Twitter or on YouTube. Why the tip? Whatever you tip, you get.
Yeah,
but that's what the technicals say. At this point, that's what the history says. Something needs to break. I haven't seen anything break.
Okay, well, that's a really good segment. And before we make it, first, I just want to say thank you for putting all this material together, and for kind of issuing this cautionary warning to folks, which is, like it or not, this just is what's happening, right? And so we're trying to prevent people from getting steamrollered by the market because they're clinging too tightly to an ideology, right? So thank you, because I know you're putting your personal brand at risk a bit here, at least of taking some slings and arrows of folks that have followed you for a good while, by saying you got to respect the bull trend, whether you like it or not, right? So,
well, no, look, I mean, yeah. Let me just interject here briefly and say, look, this is part of what I love about markets. It's a constant educational journey that challenges all of us, and we've all been guilty of this, myself included. You think, what's the old George Carlin line? If you scratch a cynic, you find a disillusioned idealist, because we all have kind of a sense of what should be, what's fair, what's right, valuations, wealth inequality, this, that, and the other. But let's face it, folks, and this is part of my major macro bear view, is this system is completely screwed without massive debt financing. And it's gotten so bad that we are now in that place where they have to spend 8% plus deficits vis-a-vis GDP just to keep things afloat. And the outlook, which is their rose-colored view, in my estimation, is $50 trillion debt by 2032. They have no choice. And this is before recession. Guess how much they're going to spend when there actually is a recession. It's insane. So they never allowed the real cleansing of the system. Last year, we talked about this controlled demolition, if you will, but we never got rid of the post-COVID excess. The amount of pain it would take to get a real proper cleansing in the system, I don't think anyone is prepared for. They certainly aren't, and they certainly aren't to take that pain during the presidential election. So, and it's not only the US, it's everywhere. And that's everywhere. Why it's everywhere. And like in the UK today, we saw the city of Birmingham all of a sudden basically declaring, in effect, bankruptcy because they can't handle their bills anymore. The message is all these high rates that we currently have to cope with inflation, they're not going to stay that high. They're as soon as they have an opportunity to actually take them down, they will have to take them down. There's no question about it. Whether it takes a trigger or not. That's
all right. So you're leapfrogging into where I want to eventually go here, which is all great. Which the end is sort of a systemic integrity question, which I want to dig into that before we're done. On the way there, though, let me make the first segue though, which is so right now we have a market that's really being driven by TA, right? Where the macro just hasn't really seemed to matter, right? You've mentioned the term lag effect a couple of times. It's something I've been repeating ad nauseum, I'm sure, for my regular viewers here on this channel to keep in mind. Is there a point at which the lag effect where the macro may actually achieve dominance over the TA? I mean, we have, as long as higher for longer is going on, we have this heavily indebted system that you just railed about, right? That is chugging now along under rates that are dramatically higher than what they were just a year and a half ago, right? I mean, we were almost near 0% at the beginning, Fed funds rate at the beginning of 2022. Now we're sitting here at 5.25, and who knows, maybe rates might go even a little higher from here. Don't know. Looks like we're maybe done, but we don't know for sure. Do we get to the point where something breaks and that breakage starts driving the action?
Yeah, every single time. No question about that. As I said at the outset, we have a couple of factors now playing that may delay it all, right? Which is the locked-in mortgage rates, the corporate debt rollover maturities, and now positive wage growth and so forth. But from my perspective, maintaining rates at this level is incompatible with the debt construct that we have. In fact, we're starting to see some signs of this already happening, right? I.e. in the labor market. Again, here's one of those areas where you can believe what you want to believe, but clearly the jobs numbers are not as rosy as they've been made out to be, as we're consistently getting downside revisions. And the structure of it all, companies will get more cautious, but they will also assess in terms of what the consumer demand side still is. This is why this is a negotiation phase here with positive real wage growth all of a sudden. Right? I can't say when this all breaks, but let's look at the past cycles. And, typically you get into trouble when the unemployment rate really kicks higher and the yield curve uninverts completely. The yield curve is still inverted. And speaking again of runway with markets, when you look at the historicals of that, it's not until you have the full inversion that's when things start breaking. So that process from the inversion going back to the neutral, that phase is still a runway for markets to rally. And then that's when the break comes and you see unemployment ticking up. What you also typically see is once the unemployment rate has bottomed and it's starting to move up ever so slightly, that's typically when the Fed is done with its rate hikes.
Okay. And just to note, kind of we did just jump from 3.5% to 3.8% in a single month, right, on the unemployment rate.
Right, and I think this is something we got to watch very closely because do we still have another rate hike this year or not? If that thing starts ticking up into, remember the Fed actually originally forecasted 4.1, 4.2% for the end of the year. I have no history looking at the Fed funds chart vis-a-vis unemployment where they are hiking rates with the unemployment ticking up. Unless they want to do something different this time. That's don't forget the dual mandate, which is full employment. So if this starts ticking up, that's typically a signal to say, okay, they're done. And then once they're done, then you have the discussion of the runway. And again, 2006, 2008, it was almost 2 years, right? In 2000, it was a bit less than that. Obviously, it was a few months. So that's then the phase we have to negotiate through. Markets will always, it's like kids on the playground, they will push the time for as long as they possibly can.
Right. Or at bedtime, yeah.
And because you do have considerations of positioning and making the quarter, making the year, and you're gonna mark up the winners, dump the losers, da 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 da. And that's why I'm saying, keep an eye on that seasonality chart, because as long as it tracks, right? And if there is a runway into next year, why wouldn't they take it if they can't, especially if the dollar rolls over and yields roll over. Now, these are also the two risk factors I've been talking about all year.
And can we talk about yields? Because you specifically said recently that we may be seeing a reversal setup and process with TLT, and there's been a lot of questions on this channel recently about, are yields going to come down, or all of a sudden we're seeing a lot of headlines that, oh my gosh, everyone's getting worried they're going to keep going up forever now. So what are your thoughts on yields?
Well, the TLT chart I posted was classic technical. I mean, forget the fundamentals. I didn't bring it with you, but it's on my Twitter feed. It basically showed a new low, filled the November gap, and the new low was in a positive divergence tightening channel, and it basically said it would pop up, and it did. It popped up nicely. Yields reversed. Now it's dropping again, and you can argue that's maybe a classic back test. So the pattern needs to defend itself. The odds are, at least structurally from a technical perspective, that TNX, which is the 10-year, may be in process of putting some sort of double top in. Okay. If that happens, you have that possibility that you get relief, that yields are coming down. That's bullish equities, until that relief turns into sheer terror. Because at some point, when yields drop really hard, that's then a recessionary sign, right? That goes then in conjunction with the yield curve fully inverted, re-inverted, and so forth, and unemployment ticking up. So these are all the pieces of the puzzle. We live in the world of instant gratification and instant movie flipping. You want things to happen right away. This is a slow beast. And I thought it was kind of, fair enough for Jay. I criticize him enough, but his recent comment about, navigating by the stars under cloudy skies is actually spot on. They don't know. Everybody's guessing on this, and anyone that pretends to have the answer, they seem to have access to knowledge maybe that no one has, or they're just pretending.
Right.
We cannot know. No one can know with any precision. Again, like geopolitical events, you can't predict them. Anything could happen. But so there's always risk that something breaks on that front, but it's not something you can predict with any type of precision. So these are slow moving pieces. I think the cycle has some unique aspects to it because of the previous regime of low rates. So we got to be cognizant of that. We have motivations, we got seasonalities, we got technicals. So there's all kinds of cases to be made that things could turn out still aggressively bullish before something breaks. But I can't tell you, when this would happen. I'm basically of the view, by the dip here, if we get a nice correction still in September, October, into 4,100, 4,200, it's probably setting up as a buy. Obviously, we'll always have to gauge and judge the technicals as they evolve. This July correction, this August correction, just set up for a really nice buy because of the dramatic level of oversold signals into key support, because it hit 23.6 FIB. It was perfect as well. So in that sense, like with the VIX hitting the trend line and S&P hitting the 23.6 FIB, BP SPX getting to 13 on the RSI, it's just a lot of confluence factor that suggested bounce. And if the seasonality chart continues to track, I guess we'll see maybe another rally into mid-September, which, by the way, next week is also the Apple iPhone event, right? And then seasonally things get shaky. So we'll have to gauge and see how that evolves.
Okay. Let me try to summarize sort of what I'm taking away from your outlook, and you correct me if I'm misstating here. I think you're saying, look, respect the bullish trends that are in place and the way the tape has been playing out. So you generally expect the markets to probably more likely continue running while the Fed continues its higher for longer campaign. At some point, that's going to break something, but probably not tomorrow. And we could have more market running ahead of us than bears expect right now. And that's the big warning flag I see you raising. Then something will break, right? That'll then throw the economy into recession. That will then start sending stocks downwards. The Federal Reserve has a lot of ammunition to deploy here. It's got a lot of room to cut and all that stuff. And it likely will, you're saying. My guess is we'll see, a quarter or two of continued market weakness, because history generally shows that when the Fed starts cutting, the market usually does have a couple of quarters of worse performance after that. But then the stimulus will kick in.
Is all you get.
Yeah, you'll get that narrow window, right? Couple quarters, all you get. And then the stimulus will really kick in, and then the markets will be off to the races again. Now, what timeline that trajectory plays out over, still TBD. We're going to need you kind of calling audibles as you see things. But that general arc I just called out there, is that your sort of default probability right now?
Yeah, I mean, look, I can't predict the future. I can just look at the history and basically what I see right in front of me. Unless this is turning out to a 2007 event where the August low just ripped straight to new highs without any corrective activity whatsoever, or 2014, then I would say VIX is really low right now. So we should probably expect some sort of volatility testing in, let's say, from past September OPEX into early October, mid-October. Just call it roughly a 4-week window where things could get shaky. Based on all these presidential pre-election years in history, it's all suggested that, and based on seasonality, it's all going to end up being bought, especially in the context that we just had these really oversold readings. Because I think if we do make new lows or retest the lows, all these signals will suddenly start showing really positive divergences. And I'm sorry, the markets still react to technicals. So unless the VIX crosses that bear bull line that I mentioned and stays above it, I think that script has a high probability to play out. Of course, when we do get a September-October correction, it won't feel like that, right? Because then the world's coming to an end again. Everybody's getting scared and this, that, the other. But I can just see that playing out. And the market, for better or worse, I mean, it's just been playing that script. So as long as it sticks on the script, I have no reason to doubt it at this point. If it veers off, then I'm going to have to question myself again in our approach. But again, the windows for bears to act in are very, very short, and the liquidity keeps flowing in terms of deficits, in terms of PTFP. Nothing of the sort has changed. So show me that's something that breaks like a chunk, and we can talk bear. But it hasn't broken.
All right. I've got 2 last questions for you before we wrap this up. And by the way, Sven, thanks so much for going so long here and just delivering so much during this conversation. It's been fantastic. So I just got to ask, because people follow you and subscribe to your service because they're trying to make more informed investing decisions. Obviously, I'm guessing, at least in the near term, you've got a long bias in general for all the reasons you just mentioned. Are there any particular asset classes right now that you think look particularly attractive? And are there any that you think look particularly toxic right now, given the lay of the land?
Yeah, so I mean, we're index traders, right? I mean, we look at just index charts, and we're trying to be opportunistic, basically. In our approach, has actually evolved a little bit over the last couple of years. In that, there was a time when I was just hyper bearish and want to be shorting everything, and I got gray hairs to show with that. Over time, we've become really practical in the sense that if we are shorts, we also have longs on, because stupid rallies can get even stupider, right?
Yep.
So
you have to have your hedges.
Like the summer, we wanted to take a crack at just the madness going on in the Nasdaq and the S&P, but we're also cognizant of the trend. So every week, Russell long, Dow long, Russell long, Dow long, every 5 EMA reconnect. It just worked a charm. Even if we hadn't done that, it would have been just absolute misery in markets. But again, you learn that these rallies can just last for a really long time, and you got to be really patient for the setup. And then when there is a short opportunity, take it, but then also be ready to pack up your bag. So basically, my general approach on all this is, now there are times when we want to be really convicted long and keep a swing long on until things get stupid again. In the meantime, have tactical longs, scale out of those on the rips, and then re-enter on dips. I mean, it's just a risk allocation process, and it's working quite well. I mean, this again from an index perspective, and we're mostly Nasdaq or the S&P or the Russell. Those are kind of three main indices, and we like doing the three of them because they also react differently to the economy, right? The Russell is more sensitive. So if there is to be a break, then we would actually want to see it in the Russell. It hasn't broken either. It's just been chopping in a range for a year and a half now. And of course, when you have hot flyers like the Nasdaq, you get really instant returns on that basis, but selling very difficult. It's an arduous process. I would think ultimately yields are going to be much lower. I guess that's why people are bullish TLT. But we have to still be cognizant of inflation data coming back in. I mean, you see oil ripping higher again. That's a concern.
Base effects are driving it up right now anyways. I mean, so there's a lot in the mix.
The base effects, but then, look at Tesla. Oh my God. I had a little fun with a little tweet on that this weekend, because Tesla had been cutting prices on their cars just absolutely dramatically.
Right.
But Model X was 120 grand at the beginning of the year. Now it's down to just below 80. I mean, talk about disinflation being all around us as well. And it's not only cars, right? We see that now with diamonds. Right?
Yeah. By the way, some cars, having just bought a used car, the used car market is still bananas, but yeah.
Well, and some of these cars coming out by other makers, basic SUVs, they want 150 grand for them. I think, you mad? There's mad pricing out there, not mass consumer market at all. But it's unclear still. We have to see those data points. But long term, yields are going to come lower again. Whether they're going to find a higher equilibrium than before, I guess, depends on the severity of any recession that's coming. To the extent there is no severe recession, we may just find ourselves in a spot that the Fed is currently denying, which is adjusting their inflation target.
Okay. Wow, there's still so many questions, but we're going to have to leave them for next time. My last big question for you, though, which your cost of living observation there sort of speaks to the heart of you and I think we, over the years have bonded over our concerns for the long-term integrity of the system. I think I mentioned this 10 minutes ago or so when you were talking. You said the only way for this thing to really keep perpetuating is just to keep issuing more and more debt, right? And that has an end date on it, right? You can only do that so long before the whole system implodes. And I think on the way there, doing that, the way the system is set up, you increasingly reward those who own financial assets and who have first access to, all the free money, because basically the way a fiat monetary system works is that money is invented into thin air through debt issuance. And so, we continue to get this vast and or aggressive and accelerating wealth gap that's just been increasingly visible in society. And then, going through what's just happened here, right, where in COVID, all the intervention that came into play shot financial assets to the moon, which really benefited the wealthy, right? But it also woke up the inflation beast, and cost of living's gone to the moon, and that's really disproportionately hurt everybody not in the top 10%, top 1%, however we want to slice it, right? So, we get to a point where it might not be a financial breakage or an economic breakage that matters. It becomes a social breakage, a social crisis. I put a video out a few weeks ago when that song "Rich Men North of Richmond" came out. I don't know if that phenomenon has caught fire on your side of the pond, but it seems like the working class and the dispossessed middle classes they're beginning to find their voice. They're beginning to really stand up and push back. I had Neil Howe on, who's the demographer who talked about the fourth turning, and we're in the thick of one right now by his calculations. And that's when you expect to sort of see this unraveling of the status quo. So I guess where I'm going with this is like, what are your latest thoughts on this? I know you have a lot of passion around this. Is there a way where we realistically can engineer a more equitable future from here, or is this thing just going to have to crash and burn first, concomitant with enough of the masses rising up and just demanding real reform from their elected leaders?
Well, first of all, we bonded over axe throwing and wood chopping, just so everyone is clear on that.
We did. And just to be clear, when Sven and I get together in the real world, I'm bringing my axe, and hopefully you'll bring yours. We'll do some chopping and some
not
throwing.
Fair, but next time I'll bring my axe. And we'll
okay.
Now, yes, you're absolutely correct. It's been an issue close to my heart for a long time. I see it in London. I see it in Edinburgh. Where I just was. The general level of poverty amidst the absolute wealth. It's embarrassing to our first world, as we like to call it. I mean, I see the occasional clips on what's going on with homelessness in America. The political divisions, frankly, terrify me for the health of society. I mean, I've muted most of the outrage accounts I can on Twitter, because I just want to be focused on markets. But I know it's out there, and it's political extremism finds a fertile ground when there is underlying social economic stress and discontent. And bad actors have been able to take advantage of this many times in the past, with often disastrous consequences. I hate to see it, and like internet was always the promise, hey, everybody has access to better information. Now it's become just a brilliant source of misinformation and hate and this, that, and the other. But the only reason that works is because, in my view, so many people are left behind. The middle class has been shrinking decade after decade, and there is no leadership, cohesive leadership, I hate to say, in any of the countries in the Western world. And I think it's really hard too, because let's say you get an adult at the table in any given country. Let's say you get a really smart guy, woman, with vision, with experience, with a heart to want to do the right thing. I submit to you, in today's political fractured world, it's almost impossible, because they're going to get torn down. They're going to get misinformation thrown on their head, left, right, and center. And I hate to say it, people believe crazy shit. They do. And the reason for that is because ideology, because you ultimately want to seek someone to blame. And that works, and especially people are out there shouting, and these guys are to blame, these guys are to blame. To solve the problems that you have outlined, you need a cohesive approach. And the problem is I don't know what the solution is, because the solution maybe just be pain, but then that makes it worse too. I mean, look, for example, if you're looking for a big blow up in the system, who's going to get hurt the most? The people that are already left out.
Absolutely.
And left behind. So if you're kind of wishing for a crash, with 10% unemployment, guess who's going to be unemployed?
Right.
It's the people that are already hurting the worst. This is what frustrates me the most about this situation. And yeah, the system, for lack of a better word, is completely rigged for the asset owners, because that's what's driving everything. If companies are doing well and the shareholders do well, they're going to hire. And if they don't do well, they're going to lay people off. But they still will have made the dividends, and they will have made the compensation on the way up, right? It's kind of an unfortunate misallocation of resources and capital.
Right.
I was hoping that maybe technology would help in a lot of this, but now this may turn out to be a threat as well. As AI is still nascent, but guess whose jobs are going to be replaced? The ones that most easily can be.
Right.
It's right.
Well, and
just to look at the basic things. Shopping these days. I mean, the cashier's on the way out, right?
Yeah.
I mean, it's all self checkout.
It's all self checkout, and eventually it'll be retinal scan on the way out. You won't even have to put your stuff in the.
Yeah, I ain't doing that.
Yeah, but and I've talked. I talked about this pre AI. This latest pre AI wave, where back during the ZERP days, we have. I assume it's the same out in the UK where you are, but we've just made it so expensive to employ humans out here. The cost of employing a human keeps going up, that we've given such a perverse malincentive to employers to automate and offshore and invest in AI and whatnot, right? So that they can basically get by with leaner and leaner workforces, and those jobs aren't ever coming back. Once you automate, you don't unautomate, right? So we're really eroding the first number, the bottom bunch of rungs on the ladder of skill development, right? So that's going to create long-term issues. And then AI, it's not just going to be the lower people; it's going to continue to creep up the white-collar stream. And look, the folks probably aren't going to shed a lot of tears for those folks, and maybe deservedly so. But to your point, it's going to disproportionately hurt the bottom of the pyramid from the workforce.
Yeah, and this game can continue as long as there's not a political break. But we all grew up in, I would say, relatively sanguine times, politically speaking. And that has been a good thing for us, obviously. But, you would think you cannot risk a societal breakdown. You simply can't. We've seen that too many times.
You simply can't. But I guess this is my question to you in this whole thing, which is, even though we can't, are we on a trajectory towards one?
Well, that's why I'm saying they're going to have to keep the money flowing to prevent that from happening. Okay. They have no choice. They're trapped. We're all trapped.
We're trapped, but they can only do that for a certain period of time, though, right? You can only issue so much stimulus.
Look at Japan. Japan has been printing nonstop, even during the inflation hiccup. It still works. I would think it would break, but if ultimately you can ease off all the pressures by going to zero rates again, you can continue this process, can you not? It's only when you're trapped and you can't reduce rates, and then the lag effects really take hold, that
Right.
you then risk that you have a major calamity happening in markets. You know,
Yeah. I'm a
it's
staunch defender that there's no free lunch. Look, if you could print yourself to prosperity, we'd all still be speaking Latin, right? The Romans would have figured this out.
well, I mean, Rome is always a fascinating analogy. I mean, I was in Pompeii in July, which was just fabulous.
I
I
saw your
loved it.
photos; they're amazing.
Yeah, it's like we all have a limited lifespan. We have a limited perspective. What I found fascinating in Pompeii specifically is that's really the only place in the world. You can go to Rome or Athens or other big historical place, and you can see the remnants of the magnificent structures. But Pompeii is so fascinating because you get a real sense, and how the population really lived, and how these towns were organized in structures. And yes, there was wealth inequality, there was poverty, there were rich people with mansions. It's kind of what you're seeing today. But it was a functioning society, and what they're able to do without technology just impresses the hell out of me. And now that town was around for hundreds of years before everything blew up. But the point is, Rome at its peak, no one, I would venture to guess, in its prime leadership would have thought it would crumble to absolutely nothing.
Right.
Unfathomable, because they were so advanced. And I'm roaming around here, England, and I see still Roman forts and buildings and structures and roads. These were impressive people. I mean, they got around, and Hadrian's Wall, right? I mean, they built up massive structures all over the place, and yet it all came apart. And it came apart because largely the same issues, which is debt, social strife, lack of growth, and then ultimately the barbarians came in, right? They couldn't hold the empire together, and corruption at the highest level, right? Because that's ultimately what happened as well. And they split the empire, and at the end of the day, the economic structure couldn't be maintained, and then it tilted into societal disintegration, and then you didn't have the leadership to address the issues, because the leadership was corrupt as well. And before you know, it was all over. I don't want that to happen. And what I see sociologically right now in the U.S. in particular is disturbing. I mean, I'm far removed. I'm sitting in the UK, but I'm looking at the political headlines every other day, and I go, really, this is where we are now? I mean, this was unthinkable 30, 40 years ago. This is devolving into a really bad show, and it's not good. When I grew up, the United States was, just universally, I wouldn't say universally admired, but it was just basically just a shining star, innovation and progress and forward moving technology, cultural, this, that, and the other. And I hate to say it, guys, you talk to a lot of people in Europe these days, and they're shaking their heads big time. And they're, what's the old saying? If America catches a cold or sneezes, the world catches a cold. I don't want social chaos. I just don't. But it could well be heading that way. And what if they split? If you have a society that can't see eye to eye on very basic things, that's where you ultimately risk that union breaks in one way or another.
All right. I hate to end it on this dark point, but you've confirmed and validated for me, Sven, that this is still something that occupies, the forefront of your mind, and it's still a big worry of yours. So we'll keep ringing this bell here on this channel about these issues, because they affect everyone in the end. All right. Well, Sven, look, phenomenal discussion. Thank you for giving so much of your time. We're almost at the 2-hour mark. Thank you.
Oh my God.
I know, believe it. It's a sign of a great interview, though, is when you just don't notice the time passing. For folks that have really enjoyed this discussion, and for the perhaps very few that were unfamiliar before this video, where should folks go to follow you and your work?
Well, on X, as it is called now, it's at Northman Trader. The website is northmantrader.com. I have also a YouTube channel at Northman Trader where I put out Northcasts. We have a subscription service where we basically navigate through this market strategy on a daily basis. We have the daily market brief where I kind of outline the major strategic talking points, and we live alerts where we do the tactical execution, and then market videos where updates the technicals every week or so in terms of the larger picture. And so we'll keep an eye on everything. As I outline right now, I think there is a chance for a year-end rally. If something breaks, I'm willing to change my mind. Obviously, we got to be practical in how we're noodling through this. But there's this runway discussion here. I think it's going to be with us for probably the next few months, and see how this all evolves. So now, I just finished on this note. The July correction fit with seasonalities. The August bottom fit with technical signals, also with seasonality. So the market's still playing a very familiar script so far, and we'll have to see how much further advantage we can take of the script running.
All right, Sven, it's been wonderful. Thank you for giving so much time, my friend. I look forward to having you back on the channel again soon, especially if you start seeing anything in the TA that makes you want to edit, the whole arc of what we've talked about today. But again, can't thank you enough, brother.
Thanks, Adam. It's great. And I think I need a cold shower now because we're in this UK heat wave, no air conditioning here. So I'm sweating it through.
Rough. All right. Good luck on that, buddy.
Thanks, Adam. Take care.
All right. Well, now's the time on the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory partners by Wealthion, to react to this very lengthy, in-depth interview with Sven. And if we've got time, which we don't have that much this week because Sven went so long, almost 2 hours worth, give us any update on what they see going on in the markets since last week. Gentlemen, great to see you. John Loder, why don't we start with you?
Okay. Hello again, Adam, and hello, everybody. Yes, very long and chock full of information talk you had with Sven. I candidly didn't get through all of it. Had it on 2x speed just to make most productive use of my commute, but got the salient points, I think. So I think in a nutshell, at least what I heard of Sven's talk is basically, and we've had a long, and we've talked about it, you've talked with many guests, from a fundamental perspective, valuations, all the things we might call fundamental analysis. We are in very, very rare territory, broadly speaking, U.S. stock market, and especially if you get down to some individual stock level, some of the Mag 7 stocks just absurdly overvalued. We will have no bashful hesitancy in saying. Yeah, on the other side of the equation, you have technical indicators, technical analysis indicators that have in the near term here regained some health and in a vacuum point to the possibility, likelihood, you might even say, for a move higher here, despite the very treacherous fundamental allocations. And just to kind of full disclosure, we here at New Harbor, we do work in both fundamental and technical disciplines. And, we think one of the key roles that we need to play for our clients in a fiduciary capacity is, basically discerning and judging when to give greater or lesser weight and in what weights to fundamental and technical factors. Basically, and maybe this is a little bit review, but fundamental analysis for those that are not initiated is basically studying from the bottom up, typically, based on earnings, sales, revenues, and valuations as multiples of those, what the fair value or the proper level of a stock or a market in general is. Technical analysis, again, just this is real simple, but for those that may be not familiar with it, essentially saying, well, the market collectively knows all that stuff, all that information's out there, and the price is the sum total of what all the market participants out there surmise the information to mean in terms of where markets are. And it kind of basically assumes an efficient market that is all-knowing. And we'll be the first as practitioners of technical analysis say, well, that's a bunch of BS because markets are not efficient or rational anyways. They may be efficient, but they're not rational at all times. And there are times where technical analysis becomes self-fulfilling. In other words, herd mentality. And we as fiduciaries have to kind of judge the weight to put in either camp. So our DNA does compel us to be mindful of the possibility of moves higher. And in fact, we've made some tactical adjustments to our client portfolios just in the last couple of days to be respectful of that, to give more upside and be slightly more bullish in a measured way. But when you get the backdrop from a fundamental standpoint, we think it comes down to position sizes. In other words, technical signals that may say, hey, path of least resistance in the near term here is likely to go higher. We think when you have a backdrop fundamental like we do now, it'd be irresponsible to say, for example, put a dramatic weighting in the entirety of a client's portfolio in kind of adherence to those technical signals. So it's technical signals can be followed, but in an appropriately sized, smaller weighting. That may be different. If we were at much lower fundamental valuations, we would be more inclined, and with good reason, to give the technical factors that much greater weight. So we're having to constantly bridge those balances and those judgments. But we agree with Sven's broad takeaway that despite the fundamental concerning picture that we can very easily paint, the near term, we think that the probability is that certainly things can go higher, and probabilities are just that. They're not guarantees. There's probabilities of up and down. The weight of evidence from a short-term technical standpoint suggests that there is likely some upward pressure here, maybe challenging the highs from end of July this year, and maybe even gunning towards the highs in the intermediate term that we saw last in January of 22. Just broad picture. I just wanted to kind of paint some broad considerations there for viewers, and so we can kind of get into more details.
Okay. As you guys know, I like myself a good analogy, and I've been trying to think of the right one to apply here. This may be stretching too much, but technical analysis, you gave a good definition of it, John, but it's largely looking at historical patterns in the market and basically saying, oh, well, when we've seen this in the past, this is likely to happen next, right? And as I talked about with Sven, hey, no doubt, narrative and technical analysis have been what has been driving the market this year. And Sven even put up that seasonality chart, which isn't really even classic technical analysis, and said, gosh, that's just the script the markets have been playing by this year. And maybe we're all just overthinking it, and we should just continue to, expect the market to follow that seasonality until it breaks that correlation. But essentially, it's just looking at old data, right? And the big question that I have is, as an investor, you have to ask yourself, okay, technical analysis is all that's mattered this year, but macro fundamental analysis really hasn't mattered at all. But that can't sustain forever. You have periods of time where technical analysis is really in the driver's seat, but then you have periods where the macro fundamentals really determine what's going on. And oftentimes it's a blending of both. And as an investor, if you're putting your chips on one horse, more or less, you've really got to ask yourself, okay, well, how long is this horse going to be in the lead in this race, right? And what am I going to do, when it doesn't look like it is that way anymore? And one of the things that the analogy that's coming to mind with technical analysis is you could say, okay, here's a river. And every time everyone's crossed this river in this month in the past, they've made it across safely. So we should think that, the same seasonality or time frame or setup in the markets or whatever, we should be able to swim across this river fine, because that's what history suggests. Now, what macro analysis would tell you is, yeah, but last week a family of crocodiles moved into this river, right? And, that's a macro change, right? And so if you're just going off historical data, there's a big risk factor that you're unaware of. And someone might jump in the river and swim across it today and make it across fine. that doesn't mean that everybody that swims across this river is going to make it across fine. Maybe these crocodiles wake up, or maybe they weren't hungry this morning when the first person swam across. And so that's what you sort of have to ask yourself when you're balancing technical and macro. Am I just going to rely on these patterns of the past, or am I going to look at the situation and try to divine what the situation calls for, given the reality that's unfolding on the ground? So maybe that's a murdered analogy. I don't know. You nodded and smiled a little bit, John. So maybe there's some truth to it. Mike, let's come over to you here. What's your reaction to all this?
Yeah, it isn't easy. We're living through a very unusual time period. And so, those that just blindly bought the market won in the last 10 years. Really, you didn't need to do much of anything. Just buy the market, buy an index fund. So much so that active managers get ridiculed to some extent. And it's pretty obvious to just about everyone, if you read the news or talk to friends and neighbors and family, that the only thing you need to do is buy an index fund and get the lowest cost one and just never touch it. But the problem, as we see it, is that we're in a somewhat semi-permanent overvalued state in the market. And this has been a time unlike any others. And I'd just like to share, I think, a chart in a minute here, and then just talk a little bit about the market, what we're seeing short term, and just explain why it's really hard to just say that you should use technical or fundamentals. We believe that fundamentals win in the long term, but in the short term, they've driven you insane. Short term fundamentals will drive you insane in this kind of market because it can stay overvalued for a very long time. So we're doing our best to react to what we're seeing, to not take drawdowns when we get the big downside that we expect should be likely, although not guaranteed, and to bring our clients through that chasm, as it were. And so what we want to do is to not have much down capture and to start deploying money at much lower levels in the market. And of course, what's been frustrating about that is it hasn't happened. But as we're talking here, I'm just going to bring up a chart that put out by our good friend John Hussman. You should be able to see that now.
Mm-hmm.
So John just put out his monthly piece today. We really like to read his monthly pieces every month, and he updated this chart, which I think is, for me, one of the most powerful charts that he puts out. This shows the market, the S&P 500 over 100 years as the solid blue line. And then it shows the levels that would be consistent based on his model, which we think is a very good, statistically reliable model, that would need to be achieved to either give a 5% return or a 0% return over 10-year Treasury bonds. 10-year Treasury bonds are essentially at around 4.2% right now. So if you're looking for a 5% premium over 10-year Treasury bonds, that would be around 9.2% or so right now. You need to be trading just below 1,800 on the S&P.
Oh my goodness!
So
less than half of where it is right now.
That's right. And so we're up here at 4,500 or so, and a lot of people are talking like this is a brand new bull market. I don't think so. I think what's happened here is just a market that deviated in the 90s due to money printing and constant intervention that was never actually allowed to correct. Each time it tried to correct, we had new and more fancy responses. Another rabbit was pulled out of the hat. In 2002, we had interest rates very quickly cut down near zero, and that caused the housing bubble. In 2008, 2009, we had a repeal of mark-to-market accounting. It was FASB 157, I think, on March 9th, 2009. And that caused the biggest blow-off top bubble ever. In 2020, we had the COVID response around the world. So, if you look at this, there's never been a time over the last 100 years where the market has traded so extremely, so consistently above these normalized levels of valuation. Never. There was a little bit of time between late 50s to, mid to late 70s where it traded above that line. And there certainly have been a long period of time that it's traded under that line. What you want to do is buy the market when it's substantially below that line. And frankly, you want it to stay there a long time during your working years so that you can dollar cost average in at fair valuations. What everyone's facing here in their what is now most people's adult lifetimes is a constant permanently high plateau that we are out there saying that we don't think will be permanent. But here it is many years later. We're frustrated. Clients are frustrated. Everybody's frustrated because none of this makes sense. The fundamentals don't matter anymore, until they do. So we are still very lightly exposed to the market. We're making some changes. We can discuss that in just a minute. We've made, because we too agree with Sven that this market can break higher, have another blow off top. But what the fundamentals say to us is that the results are going to be miserable from here forward, whether it happens sooner or later. So I will pause there, and I'm happy to share some charts on the S&P 500 if you want to talk about kind of our short-term moves.
All right, let's get there in just 1 second. Real quick, pull that chart up one more time.
All right, I'll bring it right back.
All right, so there are a couple of different data series that Hussman has plotted here based upon the risk premium that stocks have over bonds. Now stocks should offer a risk premium to bond or a premium over bonds because they are riskier. That's why it's called a risk premium, right? Investors are saying, I want a higher return because I'm taking more risk by being in stocks than versus the relative safety of being in bonds. And so the yellow dotted line there, or orange dotted line, that is the most generous risk premium versus bonds, which is 0. It's basically saying that the market is just valuing each evenly, right? And you'll see here that even to fit that generous comparison, the S&P would still have to fall by what, like 40-something% from where it is right now, 45% from where it is.
Yeah, I would have to go down to around 2,700. So yeah, it's pretty close to what you just said.
Yeah, but you'll notice in the data series here, which again goes back 100 years, right? There have only been a very few periods, which John has circled there in yellow, where the S&P has been above that very generous dotted orange line, right? And Mike, you're hovering your cursor over them right now. Those periods are not very long, usually measured in a couple of years generally. We've been over it for the longest period of time now. If you look at those two top circles in the upper right next to each other. But you'll see every time it gets up above that dotted orange line, it does inevitably correct and either touch or drop through the lowest of those data series, the green line, right, which has the highest in this data series here, risk premium. So, this is Hussman basically saying, look, if this data series correlations hold true, when this excessive period corrects, we could see the S&P down at or below that green line, which today would be below 1650. I mean, just a horrific correction in the market. So I just wanted to point out for folks here that you have to have a really good reason why, quote unquote, it's different this time to feel confident that this data series that the S&P is not going to mean adjust versus this data series.
Yeah, and if the January 4th, 2022 top was the top in the S&P at 4,800 and change, and we think it probably was, but we don't know for sure. If it was, and we fell down to that green line, that would be about a 2/3 loss in the S&P, which would actually not even bring us to undervalued levels. So that's why the stakes are high here. There's financial games that are going on that have been going on a long time. And there's no real plan B as far as we can see. Just stimulate more, and the world has to take our dollars because of the world's reserve currency. At least they have to so far. We don't really seem to have a plan B. So, at this point, we don't know how this unfolds, but we have to be prepared for a very steep and long bear market, not another V-shaped recovery. Every previous dip has been a V-shaped recovery because of immediate intervention. We wouldn't be surprised to see an L-shaped move at some point here when this really gets going. You go down and stay there for a bunch of years. And the big key there is going to be to avoid the downside and have tools in place like option selling and such that can not only hedge your entries, but give you income while you're waiting out that L-shaped move or the bottom part of that L.
Okay. Mike and Adam, before I get off this chart, Mike, I would just want to point out what maybe is obvious to viewers here, but each of those periods that were highlighted in the yellow circles, the consequence of those extremes, again, as Adam pointed out, is a pullback back, usually slicing through those other threshold lines. But the consequence in terms of return is that most of the speculative advance in the stock market that led up to those and sustained those yellow circle periods end up being given back in a very quick manner. And Sven talked about how the bear markets, especially the pullbacks of the last few years, have been very narrow. Well, that's traditionally the very case. But what happens in those kind of pullbacks is many years, if not decades, are given back. And you can see how John Hussman has annotated the chart here. You look at, for example, the S&P return has lagged Treasury bonds in extended periods after each of those crescendos. 1929 to 1950, that's 21 years if I'm doing my math right. 68 to 87, that's 19 years. 22 years from 98 to 20. And then you have 13 years from 07 to 20. So playing for marbles in the very late stage of a speculative advance is all well and good, so long as you don't overly risk capital, but also be appreciative of that can be given back really quick. So downside risk management is critically important. And as much as we want to think the exit technical factors are just as clear as they seem to be in hindsight on the upside as the exit, they're not. And even time-tested technical systems end up giving back a lot of gains in these kinds of episodes.
Well said, John. All right, Mike. Let's stop the sharing here and let you get to very quickly talking about what's going on with the S&P right now. We just pressed for time because, again, Sven went so long. We don't have nearly as much time as we normally do this week. I'll give you extra time next week.
Okay, well, I'll try to keep it very short. I'm just going to bring up the S&P chart as we wrap up. So here's the S&P 500. This is on a weekly basis. Let's start with month. This is just a simple chart within the 50 period and 200 period moving average. So here's the S&P. It came back to a 50-month moving average, and it's been straight vertical since October. We have been thinking that this is a bear market rally, that this is just a partial retracement that is going to roll over and resume the bear market. But the retracement's getting deep, right? It's getting very deep. And this actually exceeded the 78% Fibonacci line, which is actually the last Fibonacci line. So it went past that just by a little bit. Now it's back under it. But our short-term indicators have been improving, and that's causing us some concern that there could be another type of blow off top. If we go to the weekly chart, we have a 1 year consolidation, a giant cup, and it actually seems to be putting in a handle type formation. So, valuations are obscene. It's still a narrow market, which means that breadth and participation is not good. But short-term indicators are starting to reverse up. And this is the weekly chart, remember, if we were to put in, I don't know, next week or the week after another big up week, then we could easily see another blow off top because it would be a classic cup and handle formation. It's really shocking to us that all of this is happening with a 1 year treasury bills up near 5.5% now. There is an alternative, but nobody seems to care. If we go to a daily chart, we'll see here that on Friday we had this big up move. It was big up move, and the internals of the market were better. These last couple days is a pullback. And so what happens next in the next few days is going to be pretty critical. If we fell through and undercut this low, I think we would start a very steep decline. But if we go sideways for a couple of days and then up, it's going to be an issue, particularly because our internals have improved, or our short-term indicators, I should say, not necessarily our internals have improved. So it may sound like I'm saying both things, or trying to have it both ways, up and down. Our bias is very largely to the downside. But because of the short-term improvement in our indicators, because of the chart formation, we have made a couple changes. Actually, just yesterday, we closed out our short hedges and replaced them with puts that expire out in the end of December. So what that really does is it gives us the same downside hedge, or very similar downside hedge, but gives us an upside kind of stopgap. In other words, if we get this melt up that could happen, we only have a little bit of money on the table for the puts. The puts give you a very good way to know exactly what you're risking before you enter the trade, and yet still give you crash protection. So we did make that change. That did free up some cash in the portfolio that we'll be able to use probably just to park in T-bills and earn some good short-term interest rates, at present. But so I wanted to say that, yeah, we agree with Sven. The backdrop from a macro sense looks terrible. Shorter term, technically, things are improving, and we don't like it either. But we have taken some measures to reduce our risk. And also we've got some cash to take advantage of any opportunities that might arrive short term on the long side as well.
All right. Well said, Mike. So, in a nutshell, a confounding, flummoxing time, even for the professionals. You've got Sven scratching his head saying, I don't like it, but I see all these reasons the market could go higher from here. You're seeing the New Harbor team saying, we're in a similar boat, and, we're taking some precautions in case things go higher from here. But of course, your thesis and bias is that this market's going to correct at some point as the fundamentals begin to matter again. The big question, obviously, is when, and nobody knows for sure. So, all right, folks, in wrapping this up, this whole topic of these cross currents and this uncertainty and what to do about it is what the Wealthion Fall Conference on October 21st, which is a Saturday, it's coming up in a little over a month. It's exactly what our dream team of faculty that we've assembled for that event is going to be focused on and discussing. I won't rattle off all the great folks we have lined up for that just because we're short on time, but to find out more about the event as well as register for it and lock in the early bird discount price of nearly 30%. And if you are an alumnus, check your email. You should have a code from me that will give you an additional 15% discount on top of that 30%. Just go to wealthion.com/conference. All the details are there, and you can lock in those lowest discounts while they still last. But in just sort of understanding what all this means for you and making it real for you and your wealth in your own portfolio, highly recommend, as we do every week on this channel, that most viewers here work under the guidance of a good professional financial advisor, and one that takes into account all of the issues that Sven and I talked about and that John and Mike have hammered on here as well. If you've got a good one who's doing that for you, great, stick with them. They are really, really rare. If you don't have one, or if you'd like a second opinion from one who does, maybe even John and Mike and their team there at New Harbor Financial, then consider scheduling a free consultation with one of the financial advisory firms that Wealthion endorses. To do that, just fill out the short form at wealthion.com. Only takes you a few seconds. The consultation that you'll get, totally free. There's no commitment involved. You don't have to work with these guys at all. It's just a public service they offer to help as many people position as prudently as possible in advance of the reckoning that both Sven and the guys from New Harbor think is due at some point in the story here. We just don't know exactly when that's going to be. All right, folks. And if you enjoyed the conversation with Sven, would like to see him come back on this channel again soon, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. John and Mike, guys, thanks for another great week. John, I'll let you guide us out here. Any parting bits of advice for folks?
No, I think we covered a lot of ground here. I'm just going to keep it short and brief and say thank you, and we'll see you next week. I think folks have had a long sit at the computer here, so we'll give them an easy out here, and we'll wrap it up here without too much further comment.
All right, gents. All right, look forward to seeing you guys next week. Everyone else, thanks so much for watching. If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.